everyone, my name is Hui Shi and I'm from the research team at iFast. While the US is fighting elevated inflation with rate hikes, China has cut key interest rates again. Against the current backdrop, I'm here to share an update on Chinese government bonds and our thoughts on whether they are still attractive after the rise in US rates. We were initially positive on Chinese government bonds, also known as CGBs, due to their yield pickup over developed market government bonds such as US Treasuries. At the start of the year, CGBs offered a yield of 2.8%, and at that time that was about 100 basis points higher as compared to US Treasuries. However, following the sharp rise in US rates, CGBs have lost their yield advantage. The 10-year Treasury yield has reached 3.2%, while the yield of similar tenor CGBs has fallen slightly to 2.6%. And this brought the yield gap between CGBs and US Treasuries back into the negative territory, which is also the 6th month in which CGBs have lost their yield pickup this year. And as a result of this, we have turned less positive on CGBs. And we also note that inflation levels in China have started to creep upwards. Although inflation is still expected to remain below the central bank's target of 3%, the higher inflation coupled with the lower nominal yields means that the positive real yield provided by CGBs is likely to decline as well. And for investors on the hunt for higher potential returns, we think that the opportunity now lies elsewhere. The first area where investors can look at is the rest of the Asian IG universe. In particular, we have identified opportunities within USD-denominated Asian IG bonds. The yields of Asian IG have climbed to a decade high of around 4.6% on the back of higher US rates. Coupled with the massive improvement in credit fundamentals, we think that Asian IG bonds are starting to look compelling. Asian IG bonds have an average credit rating of BBB+, which is about 3 notches lower than China's sovereign credit rating of A+. That being said, we observe that the yield spread between Asian IG and CGBs has widened significantly. The yield spread is currently standing at 2%, and as shown by the chart on the screen, this is more than 2 standard deviations above the 10-year average. So what this implies is that investors are now compensated with a much more attractive risk premium for holding Asian IG bonds. Besides Asian IG, another area of opportunity that investors can consider is short duration bonds, which are offering attractive yields. As markets are worried that the Fed rate hikes would trigger a major slowdown in the economy, short-term yields have moved significantly higher as compared to longer-term yields. The current environment provides short-duration bond funds with the ability to reinvest into higher-yielding bonds. And hence, we believe that short-duration bond funds can potentially provide investors with higher total returns. Other than its relatively lower yield, another reason why CGBs have become less attractive is the recent volatility in RMB. For foreign investors, the movement of RMB is an important driver of returns. And to illustrate, CGBs have achieved a year-to-date total return of about 3% in local currency terms, which is quite decent as compared to the global bond markets. However, once converted into foreign currency, the returns were not that great. In fact, CGBs delivered negative returns in both SGD and USD terms as shown by the chart on the screen. This is due to a combination of different macro factors that had resulted in RMB weakness, including China's easy monetary policy and the growth slowdown caused by COVID-19 lockdowns. And this is also especially true when the performance of CGBs are measured in USD terms, with a return of negative 3%, as the increasingly divergent monetary policy between the US and China had caused RMB to depreciate a lot against USD. And going forward, as major economies like the US continue to hike rates, RMB is likely to experience prolonged weakness in the near term. And this would erode value from a total return basis for investors whose base currency is not RMB. But given China's strict capital control, we do also want to stress that RMB is unlikely to see any major sharp depreciation, not to mention that a sharp depreciation could threaten financial stability. And China's economic recovery could also provide some boost to its currency, although fresh COVID-19 outbreaks and renewed troubles in the property sector may slow down the pace of the recovery. Although CGBs now look less attractive than before, we also want to remind investors about the long-term benefits of including them into portfolios. Historically, CGBs have shown low correlation with global peers, enabling them to act as a good fixed income diversifier. So for instance, as shown by the table on the screen, the correlation of CGBs and the Global Aggregate Bond Index is only 0.25. Meanwhile, Asian IG bonds, despite providing higher yields, have shown a higher correlation of 0.57 with the Global Aggregate Bond Index. The low correlation between CGBs and global peers is largely attributed to the fact that the performance of CGBs is mainly driven by domestic factors. And such domestic factors involve the interest rate movements in China, which can be vastly different as compared to the rest of the world. Furthermore, we believe that there are long-term drivers for higher CGB demand. The gradual reliance in the dollar as the world's primary reserve currency has been accompanied with an increase in share taken up by other currencies, including RMB. We believe that RMB's share of the pie is likely to grow alongside China's increasing size and importance within the global economy. Moreover, recent geopolitical tensions like the Russia-Ukraine crisis have led to the weaponization of the dollar, prompting many central banks around the world to diversify their currency reserves. And as RMB undertakes a more significant role in global currency reserves, CGBs will emerge as the core instrument that central banks will invest in. And China also has a long-standing ambition to internationalize RMB as a currency to facilitate international trade and investment. And this should increase the demand for CGBs as the global use of RMB needs to be backed by a large and liquid Chinese bond market. So overall, while we have turned less constructive on CGBs due to its relatively lower yields as compared to broader bond markets and the near-term RMB weakness, we continue to acknowledge that the long-term story of CGBs remains intact. Apart from providing portfolio diversification benefits, CGBs stand to benefit from the ongoing shift away from the dollar. Investors who are still interested to include CGBs into their portfolios can consider the ICBC CSOP FTSE Chinese Government Bond Index ETF, which is listed on SGX under the ticker CYC. It should be noted that this ETF does not come with a hedged share class, meaning that investors could see their returns from CGBs eroded by sharp movements in currency markets. And for those who prefer a hedged share class, the good news is that the first and only hedged CGB ETF has been listed recently, and that is a Premier China Treasury and Policy Bank Bond Long Duration ETF, listed on the Hong Kong Exchange under the ticker 9177. So this ETF offers a USD hedged share class. It has expense ratio of 0.28%, which is only 3 basis points higher than that of the CYC ETF. And lastly, investors looking for more attractive yields than what is being offered by CGBs can consider Asian IG bonds and short duration bonds. The recommended product for Asian IG is the United Asian Bond Fund, which has an average yield to maturity of 4%. And for short duration bonds, there are funds with different credit ratings that investors can consider. And this includes the Nikko AM Shenton Short Term Bond Fund, United SGD Fund, and the Lion Global Short Duration Bond Fund. These funds invest in bonds that currently have an average yield to maturity of 3.9% to 4.8%. And with that, I have come to the end of my sharing on the attractiveness of Chinese government bonds. Thank you for tuning in and see you again next time.